Good morning and welcome to Investing Confidential. It's September 21st. It's Fed Day. Whoa, whoopee, Fed Day. Look, I think 75 is baked in for sure. I think 100 basis points as we get towards the 2 o'clock hour will become something that is definitely on the table, and I predict it will be 100 basis points just because I think the Fed believes that they can get ahead of the curve real fast here. And one of the reasons they think that is because, I believe inflation has peaked. A lot of indicators are showing inflation has peaked, and I'll discuss that in a little bit. But again, no matter what, whether it's 75 or 100, the dollar is the key. Here's a chart here, the trade-weighted dollar. Looking in perspective, we're back to 2005 levels. But again, it's the delta, the veracity of the move in the dollar over the last, let's say, 18 months has been spectacular. Will continue to weigh on assets. We may get a rally today. I have no idea. But at some point, there will be a relief rally. And obviously, the next time we report CPI, it's going to be lower. Most likely, you're going to get these kind of relief rallies. But the bottom line is that the damage has been done. The dollar is very strong, will continue to be very strong, at least to the end of this year. Look at the 2-year bond, it's spiking. This has a real effect in terms of how people price real estate, how people are pricing in stocks and dividends, all of these things. There's going to be a reset, and we're seeing that reset now. And even if we do get a rally, those rallies are to be sold because this reset is going to be significant and will put PE ratios, dividend yields are all going to be adjusted because of, and again, the dollar and rising rates. One of the things that's interesting is that the EU is responding much more aggressive than the US. Their inflation issue is much greater. Their CPI is approaching 10%. They have a winter coming that they're going to have energy issues. So the EU is aggressively raising rates. At least the smart countries are raising rates. This may help the plummet in the EU. The EU now is below parity. It's a great time to be traveling to Europe, great time to be buying goods from Europe. But if you sell into Europe, you got problems. And as I mentioned to you, earnings this season will beginning to be affected. Tech companies, etc., are going to have big problems in earnings in the next few quarters. That's another reason why any rallies that we get due to inflation dropping or the Fed, whatever this Powell's going to say, is to be sold. So again, watch the dollar, watch the euro. These are going to be key indices in the next few days, and then obviously for the next few years going forward. The big news today is Russia warning the West. Politically, I'm not going to get into it, but this is inflationary. I mean, that's as an investor, the only thing you should worry about is this inflation. Outside of buying defense stocks, this is inflationary. It's bullish gold. It's certainly bullish dollar, and the last thing we need right now is a more bullish dollar. So again, looking at the dollar on a trade-weighted basis, we're at a 2-decade high. It doesn't seem on an overall basis the dollar is going to retreat anytime soon. It will, but not anytime soon. Another big news that came out today was, and this is pretty significant, Germany nationalized one of their biggest energy producers, Uniper. I think we're going to see this across the board in Europe, and it's not good, okay? The papers are writing, oh, they had to do it, the debt and all this. Look, nationalization, no matter how you slice it, is not good, okay? I've seen it around the world. It doesn't work. It usually leads to bad things. And nationalization of energy companies, because even in this dire situation, is a bad thing. I want to address something now that it's going to be talked about right after we get through this Fed and this discussion about inflation, which is GDP. All right, so we have had real GDP has been down. Again, real GDP, not nominal GDP. Real GDP has been down, and that's adjusted for inflation, 2 quarters in a row, negative. The consensus now is 0.3% for the growth in the third quarter. But They're using something called GDP now. Now, this is a joke. It happens on Wall Street a lot. Whenever things don't go your way, you change the way things are looked at, right? So when PEs don't work, you look at EV/EBITDA. When EV/EBITDA doesn't work, you look like adjusted EV/EBITDA. The government's doing the same thing. GDP doesn't work for them. So now they've adopted something called GDP now. The Atlanta Fed is pushing this narrative. And if you looked at the calculations, which I have just looked at this morning, I mean, the spreadsheet is massive. This is an obvious way to adjust GDP, try to make it look better than it really is, but it's the reality. This is what they're going to do. So we're going to have, I'm pretty much believe that GDP's negative, this economy is in big trouble, but the GDP is going to show a small positive because they're using this thing called GDP now. Okay, just be aware of that. Another interesting story, or another interesting news today, not news, but more of data, looking at this whole idea of the economy and how good it is, and the government pushing this narrative of, low unemployment. Look, the way they calculate unemployment rates, I mean, if you saw the numbers, Indeed and all these agencies, I mean, anyone could post jobs, right, and say they're not filled. So I think this whole narrative, I think this is bunk. I think, sure, there are some industries like the restaurant industry and others that are suffering, but overall, again, I think there's been a manipulation of data, and that we don't have this situation. But no matter what, things are reversing. And one of the interesting anecdotal data is right here. Bank deposits. Look at the statistics. Bank deposits are plummeting. Okay? Bank deposits spiked in the 2020, 2021 because the government gave people lots of money, right? A lot of free money came out there. People put it in the bank. People gambled with it. People, bet with it, whatever. And obviously bet when I mean stock markets. They bought crypto. They bought stocks. They bought whatever, options, whatever it is. It was a wonderful time. Free money. That's ended. Okay? So all that money is running out of the banks because people have to pay bills. They have to go back to work because the money has been depleted. So this is showing you, this evidence is showing you that the unemployment rate is going to start rising rapidly. Okay, we're going to see a big reversal in the unemployment rate because free money is over and people are now depleting their bank accounts and they have to go back to work. That's the bottom line. So look out for that. And then one interesting thing today here also is talking about inflation that has peaked. We want to look at one of the indicators, which is rent, right? So rent is something everyone focuses on. It's saying rent is skyrocketing. Well, look, rent is not skyrocketing. These are statistics. There's plenty of houses to rent. Sure, if you're in the New York area, if you're in Los Angeles, you're in San Francisco, of course, there's not enough apartments to rent, but their buildings have a lot of empty apartments. They are holding back to get higher prices because they know that if they lock you in for 2 years and they can keep doing that and then they keep bringing the apartment slowly, they're going to make up for, let's say, what they lost during the initial stages of COVID. But look, housing starts. One of the interesting about housing starts, multifamily construction is surging, right? Housing starts would have been much lower if it wasn't for multifamily. Why are real estate companies building multifamily homes? Well, they see the statistic that there's not enough apartments for rent. So they're going to flood the market with rent just at a time when the statistics are showing that rents are coming down. Okay, this is classic. So we're going to flood the market with multifamily homes to rent when there are plenty of homes to rent and rents are coming down. This is perfect. If you're a consumer, if you're someone who's been priced out of the housing market because of the large institutions, Open Door and some of these Zillow, they got big problems because they bought houses sight unseen and they created this issue, this bubble. But that bubble has popped. Housing prices are coming down. Rents are coming down. So all you need to have is patience and you're going to get very good prices in the next, let's say, 6 months to a year. Another inflation indicator, why I think inflation is going to look at port congestion, especially on the West Coast, which is where we import most of the goods from Asia. that has plummeted. So again, anecdotal evidence, inflation is coming down. But when I say inflation is coming down, it's not going to come down to 2% like the Fed's target. We're talking about 5-6%, very sticky inflation. But again, the headline number is going to be reduced. The White House is going to raise the flag saying, hey, we did it. And the market will probably rally, but it's a short-term thing because inflation is monetary. We printed a lot of money, and all these other factors are combining for it to be sticky. So we're not going to see inflation be reduced to where the government and the Fed hopes it to be reduced. And then I want to talk about real estate because I'll always mention real estate. One of the things you need to really understand with real estate is what's happening and why real estate is probably going to go significantly lower. Real estate is priced on cap rates. Cap rates is essentially the easiest way to put it is what yield you can get on a property. Right now, the cap rates are very low. Okay, if you're as a professional real estate investor, you're selling real estate, not buying real estate. On this chart, you see it's the single-family cap rate versus the 6-month Treasury yield over the actual yield of the Treasury. Cap rates are very low. Cap rates are probably in the 2.5%. The actual cap rate's 2.5%, 3%, maybe even lower. Cap rates must go higher. They traditionally, if you're going to make money in real estate, you want to buy 7% cap rates or higher. Right now, they're again below 3%. That means that when cap rates rise, real estate prices go down. So again, another evidence that we're going to see a significant reduction in the prices of real estate. One last thing to mention in Bloomberg. So this guy, Dr. Doom, Rabini, and he's saying stocks going to go down 40%. I mean, if this isn't an indicator that stock's going to rally in the short term, I don't know what. I agree that over time we're going to see a significant movement lower in stocks, but it's not going to be 40% by the end of the year. Or I don't know what he's saying. I'm not a big fan of Rabini, but anyway, if that's, again, this is another one of these reverse indicators. I would fade Dr. Doom in the short term because of what he said. Again, over time, real estate, stocks, financial assets going significant lower as rates and inflation stay higher and sticky. Have a good Fed day, and we no idea where the market's going to end up. Flip a coin. That's probably better than even trying to predict it. But there is going to be volatile, and the way it looks like, most likely, if Powell goes 75, the market is going to rally significantly. I believe he's going to go 100, and if that's the case, the market will crash today. Okay, just today. Anyway, happy trading.